The reality is, for a lot of people out there, you can't get your job done unless you are using your motor vehicle. And if you're using your motor vehicle, I dare say you want to make it a tax deduction in your next tax return, especially with the 2025 tax return season being here. It's a good reason to get on top of understanding what you can claim in your return, how you can reduce your tax, but also doing it legally so that you're not going to have any problems with the ATO knocking on your door. If we're not growing, you're not growing. If you're new to the podcast, welcome. My name's Nathan Rigney. I'm the Profit Generator. I am a CPA. I am also the Deputy Chair of the New South Wales Public Practice Committee, which is basically a committee with CPA members. I'm certified to really help clients understand a lot about business psychology and a really good understanding about how they spend their money, and how, when you get that really good understanding about what's happening in your mind and the habits that you have, so that you can correct those and get into a position where you are more profitable. I'm all about helping you guys become better at what you do, so you have a better life, so you have a job or you have a business that serves you instead of being the other way around. Today's podcast, it's all about understanding the two primary methods when it comes to claiming your motor vehicle. And there's different reasons as to why you would use the two different motor vehicle deduction methods, and it really comes back to your own personal circumstances. Your circumstances will really determine which method you go and apply and which one's best for you. So the reason I'm doing this podcast is because the big thing that's happening at the moment with AI and technology is that the ATO are so many steps ahead of being able to understand and see whether the claims that you are putting in your tax returns, whether you're running a small business or you're an employee where you just got an individual tax return, the ATO, they are streets ahead. And I think that a lot of the public out there are not really understanding or really know how smart the ATO is when it comes to understanding whether they think a tax deduction is legitimate, or maybe people have taken the piss and they're claiming a little bit more than they should, or maybe a whole lot more than they should. So with technology and everything that's happening, the ATO, they're on top of their game. And I'm telling you, as I said with one of our recent podcasts where I was talking about the ATO having $105 billion of unpaid taxes, the ATO Commissioner is doing whatever he can to make sure that he gets every tax dollar to really get that ATO debt down. I just don't want to see any of my clients, any of my viewers, any of my contacts, anyone that's out there that I know, really getting themselves in a position where they're doing the wrong thing, whether they knowingly are doing the wrong thing or it's just that they haven't been educated. I just want to cut down this potential of the wrong thing being done and then possibly being caught in a position where you are being audited by the ATO and they're throwing a review at you and they're changing all your returns. Because I'm telling you, you don't want to do that, because if they find there's errors in 1 year, they're potentially going to go back a few more years and claim, which could be big dollars for you guys on extra tax that you didn't know you had to pay back. So let's talk today about motor vehicles. And I dare say for a lot of people, this is going to be so relevant. Whether you're an employee where you use your motor vehicle haphazardly, it's very sparingly, and you don't use it a lot, to someone who's using their motor vehicle a lot, and it's like their second office, right? Or maybe it's their primary office, especially those that I know are in real estate. But let's get back to basics. The first method that I'm going to take off and look at and talk about is the cents per kilometre method, right? So this method is really great for those who are not doing a lot of travel in their motor vehicle. So that might be that you've got a job, or even if you've got a business where you don't have to use your motor vehicle a lot. And it might be that, hey, there's a few trips here and there, or it might even be that it's just easier for you to document the kilometres that you're travelling. But the cents per kilometre method basically looks at you as the taxpayer writing down or keeping a diary note or a record of the trips that you've had and the kilometres that you've travelled for that purpose that are work-related trips. When we talk about a work-related trip, it needs to be basically something where the purpose of the trip forms part of you earning assessable income, right? So if your employer says, hey, I want you to go and visit a client, sure, that's all right. You go from the office and you go to the client's premises or house maybe, and the kilometres there and back to the office are claimable. But before we get into the cents per kilometre, let's talk about general rules around travelling in your motor vehicle. What is a business trip and what is not? So a lot of people, especially our younger viewers, our younger taxpayers that I meet, always think that in their cents per kilometre claim and all the kilometres they're claiming for work, that they can travel going from home to work. Now, unfortunately, even from work to home, vice versa, none of that travel is ever tax deductible, and the ATO looks at that as being private in nature. So it's a private travel you getting to work. But the thing is, if you go from your workplace and you go to a work-related premises, or there's work-related travel from the office to the set business location you're going to, and that could be anything from maybe going from the office to the Australia Post to pick up the mail, or it could be going to visit a client from the office. But that travel to and from those locations, from that set business location, is what we would be relating to as being work-related travel. So think about that when we talk about travel. So with the cents per kilometre method, let's go over how that works. In a nutshell, the best way to describe it is that throughout the year, you can claim a maximum of 5,000 kilometres per car of travel throughout that whole financial year. And so that could be a whole host of different little trips that are here and there that make up to 5,000 kilometres. And there are a few exceptions of what you need to do to be able to do this. First of all, you must own, or you must be leasing or paying off a vehicle. So the vehicle, the rego papers, they need to be in your name. The second thing is that, unfortunately, if you've got a motorbike, that's not going to count in this cents per kilometre method example. But if you do have a car, we need to understand what the definition of what a car is to the ATO. A car is basically, it can carry less than 1 tonne, and including you, the driver, 9 people in the car. So essentially 9 passengers in the car. It is also an electric vehicle or a hybrid vehicle as well. So that's included as being a car. So the way it works with the cents per kilometre is you get 5,000 kilometres you can claim throughout the year. But you do need to keep a record of those journeys, those travels that you've done. And so the best way to do it is you can either have a diary, or even just maybe keep a spreadsheet or a piece of paper, but you just need to be able to have as much records or as much detail about each one of those journeys. And so that could be as simple as going, well, the kilometres from the office to, say for example, the Australia Post office, or maybe going to get some stationery or seeing a client, who was the client, the details, and writing down, I started at suburb A and I finished at suburb B, and this is the kilometres, and just a little bit of details. But basically, the more records, the more details you have about that trip, the easier it's going to be for you to substantiate and prove that travel did actually occur. So remember, if you're going from your place of work and you're going to see the client and then coming back, those kilometres are claimable. So the reality is that if you're not doing a lot, you can claim up to 5,000 kilometres on this method. If you're doing a lot more travel and you're finding that you're almost living in your car, this method would not work for you as well. So the way it works then, once you know your kilometres, the ATO has a set rate per kilometre that you can claim. And this set rate includes basically all your petrol, includes all your repairs, and thinks about depreciation, interest on your loan. And this rate changes every year. So for the 2024 financial year, it was 85 cents per kilometre. Whereas in this financial year, we're just finishing the 2025 financial year, it's 88 cents per kilometre, which basically means that what you're going to do is you're going to sum up all your different trips, the total kilometres, and then what we're going to do is in your tax return or your business schedule, we're going to look at those kilometres and apply it by the ATO set rate. So in the 2025 year, if you had 100 kilometres that you've done for the whole year, it's 88 cents a kilometre. You're going to claim $88 in your tax return for that travel. Easy peasy. So the next method is if you are using your kilometre a lot, and like I said, you're someone that is doing a lot of travel and you might be like a salesman, or there's just a lot of time in your car, you might want to do a different method because the cents per kilometre is quite limited, right? You only got 5,000 Ks, which means that 5,000 Ks by the set rate, that's all you can claim. But if you're finding that you're doing a lot more travel, and what I typically say is if your travel is at least 50% or more in your car, you might want to look at doing the logbook method. And what the logbook method basically does in a nutshell is it's working out, well, as a percentage, how much of your car is being used for work-related purposes. And then finding out that percentage and then applying that percentage So say, for example, it was 80% work-related for my vehicle. 80% of the time, I'm using my vehicle for work-related purposes to earn assessable income. I'm going to take that 80% of all my costs. So that could be like your petrol, your rego, it could be even depreciation on your car, it could be the interest on your loan. We're going to basically apply that 80%, and that's what we're going to claim in your personal return. So if you were traveling a lot and maybe you've done like 15,000 kilometers in the year, that was all work-related trips. If you're using the cents per kilometre, we could only claim the first 5,000 kilometres, and then the remaining kilometres we wouldn't claim at all. So you could see that the logbook method is going to work out better for you as a better claim, and then help you reduce your taxable income and maybe even reduce the amount of tax you pay. But to do a logbook, it's just not as simple as thinking, oh, I think I do 80% work-related travel. No, what you need to do is the ATO actually wants you to demonstrate how much of the car is being used for work purposes. And so the way we do that is that you need to keep a 12-week diary of everywhere that car goes. So, you're going to document every trip that is private, every trip that is business, all the car journeys that you're having. Basically, what is the purpose of the trip? Who are you seeing? If it's private, if you're going shopping, I don't really need to know what you were shopping or what you're doing, but you just might want to say, hey, I'm going to my local Westfield from home, and just say shopping. We don't need to know that you've got a new outfit or whatever. But really what the ATO really wants you to demonstrate is how much of the car is being used for work purposes. That's what we want to get to, because they want to be able to basically see that the travel you're doing is legitimate. So the details you're keeping is everything from the opening kilometres of the vehicle to the date you travelled, to the purpose of the trip, the people you're seeing, or the purpose of what you're doing. It's as much details as you can. And as always, the more details you have, the better record you're going to have when it comes to possibly the ATO doing an ATO audit or reviewing your logbook. And then potentially, if you have more details, you're less likely to be in a position where TO says that your logbook is not valid. But to get it back to basics, the way the logbook works is you do the logbook for 12 weeks, and it's not meant to be a period in your busiest period or your quietest period. The ATO prefers that you do your logbook in a period that is just an average representation of what work would normally look like for you. And so once you've done that logbook for 12 weeks, it is then valid for as long as you keep that car, the same car, for 5 years. As long as your job is very much the same. It's 12 weeks of pain keeping this diary, but then it's valid for 5 years, assuming that everything stays the same. Now, the thing is, with a logbook, you can do it two different ways. You can go to, say, Officeworks, or maybe like your local newsagents, or just anywhere that sells stationery, where it's a book that is handwritten out. Like the one that we typically have seen a lot is it's like a yellow cover, and it's got all the fields written out for you just to write in there with pen and paper every trip, and it's your book you keep in your car for 12 weeks. Or the other thing with technology is that you can download to your phone apps that will connect to your car and then look at using technology and GPS, map out everywhere you're going. You still can put a little bit more details in it, but it's an easier way of doing it, and it then also automates this process for you. But essentially what we're doing is, once you've done your logbook, and particularly with the manual system, is that you're going to have two columns. You're going to have your private travel and you can have your business travel. And we're going to look at your total travel as a total. You want to work out the percentage of that business travel to the total travel. And that is the percentage you're then going to use to claim everything on that motor vehicle. And interestingly enough, actually, with electronic vehicles or hybrids, it's a little bit different because you're not going to a petrol station to fill up petrol. If you're not using charging stations where you have a cost that you can demonstrate and you are charging at home, the ATO does have a set rate of 4.2 cents per kilometre for every kilometre you use throughout the year. So it's a little bit more difficult with an EV, but it's not that hard once you know what you're doing. Essentially, we take this business percentage and we are applying that same business percentage for the logbook against all the costs you've had throughout the year. That could be the charging station cost if you have an EV. It could be repairs and services. It could also be your registration cost for the year, like your CTP. It could also be insurances that you're going to have, like your comprehensive insurance. And then on top of all of that as well, if you've bought the vehicle, you can then claim part of the depreciation on your car every year. And then if there's any finance owing on the car as well and you're paying interest on that finance, that interest can also be tax deductible as well, based on that logbook percentage. So what happens in the end is that if you're doing a lot of travel, it works out to be an actual better method to go and apply and use than the cents per kilometre method. The issue is that you need to make sure you keep a logbook. And if you don't have that and the ATO comes knocking on your door and wants to review your claims that you're making, they're going to want to see this logbook. So hopefully I haven't got you all nervous about this whole logbook thing. It is pretty easy, but there are a few things that have come up recently about logbooks that I want to go through with you just to make sure that you are 100% over what you need to know about doing a logbook. So logbook method, there's been a little bit of attention with the ATO and they have been spending a little bit more attention about what people are doing, how they're doing it. So let's talk about some common mistakes that are leading clients to a position where, or taxpayers out there, to get their claims disallowed. So the first error that the ATO has spotted and has been reported is that people are doing logbooks and they're not keeping for the whole 12 weeks. So if it's not 12 weeks, it's not going to count. The ATO would disallow, and the best you'd be able to do is if you don't have a valid logbook, they would say you have to go back to the cents per kilometre method. So keep 12 weeks logbook. I know that I've kept logbooks myself and it is painfully annoying, but it's 12 weeks once for the car, and the reality is you're not swapping out and changing cars every year. If you keep the car for a long time, it's once in 5 years and then it's done. So make sure you keep the logbook for 12 weeks. The next thing that has become a big attention to the ATO is not having an opening and closing kilometres of your motor vehicle. So every year, at the start of the financial year, you need to note down what the opening, or I guess the kilometres are at that point, and then let your accountant know when you're filling your return in. Now, that could be years after you've done your logbook anyway, so every year you need to work out what your kilometres are closing at the end of the financial year, and that needs to be reported into your personal tax return. The next thing that the ATO doesn't like about the logbook method, or where logbooks are falling over, is vague descriptions in the logbook, not really keeping really good records, so not having dates about the trips. And then the ATO will go as far as actually having a look and saying, if your diary says that you had a trip to go see a client on X date, but then in their review, if they actually audit your logbook, they could then have a look at your diary personally, maybe in your work-related job, and match up the data. So what's going to happen is if, say for example, the ATO has a look at your logbook and they find that there's a mismatch in events that have occurred, that's where basically your logbook's going to fall down. So if you're keeping a logbook for 12 weeks and you drop your motor vehicle into your local mechanic, or maybe you're going back to the dealership for a service, and your invoice that you get, that you're claiming for these services, if they don't line up, or they're going to then see that, hey, if it doesn't line up with your logbook, then potentially your logbook could be considered fraudulent. So it's really important to keep pretty much a clear description of the trips you're doing and having really good record. Vague descriptions like business trip or client visit, that's not enough. Instead, you want to write something more detailed, like a client meeting at Menai, or 2 client site visits in Sydney CBD. And you want to jot down the name of the client as well. So the more details you have, the more likely the ATO is not going to pull apart your logbook. So don't be vague in your logbook descriptions. Now there's another good one that the ATO has spotted as well. So the dates in your logbook don't match your work records. So the ATO, they will go as far as even speaking to your employer when they do a audit of a logbook or review of a logbook. They'll go reach out to your employer and say, when were you away for the year, and then on annual leave or sick, and then they'll start matching up those records with the logbook you've kept. So be aware of that one as well. And the other thing as well is, on top of that, like now with single touch payroll, the ATO has the ability to have a look and see these records, because we report in our payroll the different type of pay balances, and in a pay fortnight, for example, your pay period might have your normal hours worked, but then also have leave allowances that you would have got for that period. The next thing is the ATO doesn't like seeing that a logbook has been prepared at the busiest time of the year. They are very much aware that people are out there completing their logbooks when they're most busiest, because the reality is you're going to get a higher percentage. So it's really important that you keep your logbook in an average period that represents your average year of you working. And lastly, the last thing that the ATO has been focusing on is people having out-of-date logbooks, so they're older than 5 years. So it's really important that if you've kept that same car for more than 5 years, that when the logbook gets to the end of the 5 years, that you've completed it. So if you completed it in in, say, 2020, now it's really important that you, being 2025, that you complete a new logbook. But even like I said earlier, it might have been also that your circumstances have changed. So if you change jobs, or maybe you've got a promotion since then and you're not doing as much travel, it's just not when the car changes, but it's also when the circumstances change for you personally that you need to go back and you need to redo your logbook. And I know these all sound like silly things, but these are the things that the ATO are concentrating on to basically disallow logbooks and the percentage that you're claiming on your motor vehicle expenses. Well guys, you know what? Claiming motor vehicle, it is one good way to really up your tax deductions and reduce your tax personally. But it's really important that no matter which method you're using, whether you're using the cents per kilometre method or you're using the logbook method, that you get it right. And it doesn't need to be a hard job, doesn't need to be a burden, but it's really important that if you do want to claim this stuff, that you do take the time to keep really good records. And it's not hard. If you do this throughout the year and you just keep a record somewhere, and especially in today's day and age, it doesn't have to be pen and paper. It could be on your phone. Keeping a file note on what trips you've done, so that when it comes to tax time, the more details you've got, the more records to demonstrate that what you're wanting to claim is legitimate. It's going to mean that if you do get an audit from the ATO, that you are prepared and ready to actually go and claim it. Now, I know with my firm, any of those records you give us, we keep that on file. So if you lose that, that's fine, but it's no problems. But as long as you email, you give that to us when we do your tax return, we've got that there. Work out the method that works best for you. As I said earlier, if you're doing very little travel, the best method is probably going to be the cents per kilometre method. But if you're doing a lot of travel, and typically industries like, say for example, real estate agents, it's probably best that you do the logbook method. And even if it is, you're using your car 99% of the time, or you say that, hey, it's always being used for work, you still got to do a logbook. Well guys, I hope you found that informative. And if there's anything that you would like to see on the next podcast, please get in touch, write a comment, and we'll be sure to record that for you next time. Bye. It could even be that if you have a huge member balance, that you might want to look at the idea of having super, because the cost might be lower to run your super fund as well. Just remember that the minimum super balance really that you need is at least, an ASIC recommends $200,000. And then upwards from there, those costs of running your fund become less and less as a percentage. So what I would say is, before you go and set up a super fund, there are a few key things that you really want to look at. How much time do you have to commit to this on a week-to-week basis? How much time do you have, and do you have that ability or want to do that? The second thing I would say is insurance. Looking at your current insurance, and then looking at when you close your retail or industry fund and then coming over to a self-managed super fund, how is your insurance that you have within that fund going to be affected? What's the strategy you need to think about to still have the right insurance, but then also not be paying more? My third point is, are the costs going to outweigh the benefits? If the costs are huge and you have a small member balance, just like that client I was talking about at the start of the podcast today, and you have a member balance of $50,000, you have a lot of ground that you need to make back up in the investments that you're going to make to then recoup those initial setup costs, but then also those ongoing costs. The fourth thing that I would say that you really want to consider is, you want to do something different. You don't want to be in your industry fund anymore. Maybe you've got to consider other options. Is it maybe moving to a different industry fund or a different retail fund that has a better return or a better performance? Is it maybe speaking to your financial planner and saying, I want to do a wrap account, which still has a bit more flexibility and the ability to choose where you invest money in, but not as complex as running a self-managed super fund? So fourth thing is, what are the other options before you get to running a self-managed super fund? Understanding what are the returns going to be likely on every different avenue. And my fifth thing that I would say that you need to really think about is, what goals do you have in setting up your self-managed super fund? What are the goals that you have in the next year and long term, 3, 5, 10 years in time? What are those goals and what do you want to achieve? So let's do a little bit of a challenge. If you had to rewatch this video, or you have been writing down all the pros and cons, which one gets the highest score? If you get mostly guesses out of everything we've been talking about here, maybe you should have that conversation first with an accountant or maybe a financial planner about setting up a self-managed super fund. Have that conversation first and then take the next steps. But what I would say is, if we did a quick test now, number one, do you have more than $250,000? A positive, like a pro, is yes. Number two, are you willing to take on the legal responsibilities as being the trustee and getting everything right. And remembering that if you get it wrong, you could be losing half your balance if your super fund becomes non-compliant, because the ATO will tax you at the highest marginal tax bracket on the whole balance. Number 3, do you have the time, the support, the interest, or the willingness to actually want to set up a self-managed super fund? Number 4, do you have the right skills to be able to do this? And when we talk about skills, the right investment knowledge to make investment decisions that are going to be meeting that sole purpose test of increasing your member balance in your super fund. And my number 5 test would be, are you okay with those additional costs of setting up the self-managed super fund year on year? Remembering it's going to be between $5,000 to $10,000 to run a self-managed super fund every year. Well guys, that comes to the end of our podcast today, and hopefully now you know a little bit more about super and what a self-managed super fund is, and it gives you a little bit more information and to help you be a little bit more informed. Ultimately, I don't want you guys to be another story like that client to start with who only has $50,000. It's just going to be a disaster, because when you set up a self-managed super fund and you roll all the money in, even if you decide to close it, it's just not as simple as just closing it. There is a lot of processes and things that you need to do before you close that super fund down. So don't be another story, be informed, and then if it's right for you, be another one out there who set up a self-managed super fund, just like myself. I've got one as well, and they can work really well for you, but it all needs to stack up before you go and do it. Thank you for watching, and remember, if you've got any content ideas that you want me to talk about, please drop us a note and we'd love to hear about it so then we can talk about it on our next video. See you guys, have a good one.